Well, now we're joined by Kevin Daly. He's Emerging Markets Debt Portfolio Manager for Aberdeen Asset Management. He runs about $6 billion. And in looking at your notes, Kevin, what stands out is that you are not excited about Brazil, a country that the PIMCOs of the world are very excited about. Why do you see risk there?
Well, we still think long-term Brazil is a good place to be, but I think in the short to medium term, we think the risks have increased. For example, with the transition to the new government, initially we thought the finance minister Mantica would not be staying on board. He is going to be part of the administration.
The man who minted the term currency war, talking about these hot money inflows because of the easy money in the U.S. searching for yield and going down to Brazil from his perspective.
Yeah, and then we've got a transition from the central bank governor from Morales to Tombini. There's concerns about the autonomy of the central bank now, with both the incumbent president Dilma Rousseff and Mantica making comments about maybe the possibility of an interest rate cut in early 2011, which to us is just complete a risk to Brazil rates, because right now inflation is actually increasing in Brazil, so you can't be talking about interest rate cuts in the face of rising inflation.
So when you look at the rest of Latin America, though, I mean, do you see further concern for capital controls or similar story, or is this a one-off?
We think there's a low risk of capital controls in Latin America. For example, we've had recent meetings with officials from Peru, from Mexico, where they've highlighted the likelihood of, the chances of any currency controls, capital controls will be pretty low in those economies. Colombia, there's a little bit more risk there, because in the past we have seen noise from Colombia about the strength of the currency, but obviously the peso has been weak as of late. So, but that would be the one country to look at, maybe some sort of controls if we saw another acceleration in the appreciation of the peso.
A country on your list that you're overweight on that surprised me was Venezuela.
Well, Venezuela, we've recently gone from underweight to a market weight and then overweight now. I mean, Venezuela is a country which still has a lot of risk. At the same time, a lot of yield. I was there on a trip recently, and I think one of the things the market is not pricing in Venezuela is the significant oil discovery, the production, increased production from the Orinoco Belt, and that's something which potentially gives Venezuela enhanced ability to service its debt. So clearly that's not being priced in by the market, but at the same time there's a lot of risk in Venezuela, so it's not for the faint-hearted, as they say.
Well, one of the arguments for putting money to work in Latin America, or in Brazil in particular, is that the road to Beijing leads through Sao Paulo or elsewhere on the continent, and that is that the long-term bet is on growth because of China and the demand for natural resources and the like. So, a bigger picture here when you look at what's happening in China. Connect the dots for me. Yeah, I mean, obviously China is very important for emerging markets, for Latin America in particular, given the very strong commodity demand that we're seeing from China. So risk of a hard landing in China, which is a very low probability, but has that risk has increased recently with inflation now picking up, would be a negative for Latin America. So key is tomorrow we're going to see the November inflation data from China. Market will be putting a lot of emphasis on that report, concerning what happened in October. Are you changing positions ahead of that?
No, we're not. I mean, I guess at this point, we are concerned about food prices in China. They were increased 10% year-on-year last month, so that's going to be a key focus for the market tomorrow. We see that the data come out.
All right, Kevin, thank you for taking us around the world.
Yeah.